rule changes that are both very aggressive in terms of the speed and the size of the impact. Just for example, in terms of testing, we went from a week ago when we spoke, we were able in the U.S. had capacity to test about 20,000 cases per day for coronavirus. Now that's tripled in a week. We're up to 60,000 per day, and that's truly, I think, is the key to getting the virus under control is to have a capacity to test. They're developing tests to detect antibodies. We're expanding healthcare facilities. I mean, some of the moves have been really quick. New York is looking to expand their hospital capacity by 50%. We've got companies manufacturing ventilators, increasing productions of masks. Even on rule changes, the FDA has responded. They're fast-tracking drugs and vaccines. They're allowing the experimental use of treatments. So there's really a lot going on. We know the negative impact of the virus. It's going to be pretty severe, and it's certainly impacted the way of life, and will have a financial and economic impact. But I think the policy response is something that the market is starting to appreciate.
And Greg, can you just mention one of the things that happened earlier today was the market was up, not a tremendous amount, and then it just surged. And I called Greg and I'm like, is there any specific piece of news that I missed? And Governor Cuomo was speaking. Can you just touch on that real quick?
Yeah, I've been listening to the New York State Governor Cuomo's press conferences every day, just because New York is the epicenter of the virus outbreak in the U.S. for now, and I've noticed that the tone of the conference calls tends to have an impact on the market. And today, in the last few days, the tone of his press conferences has changed. There's a little bit more positive. I mean, today he was pointing out how the containment measures may be working, and how the growth rate in hospitalizations has come down substantially in the past 5 days. So there's some positive news at the epicenter of the outbreak in the U.S.
Right. So, okay. So I think from here, I'd like to get into the portfolio itself. And I know one of the questions. Well, I just want to remind everyone on this call, for the most part, has a different portfolio, right? So our three primary strategies that we manage are the U.S. dividend income stocks, the international income stocks, the U.S. disciplined growth stocks, and then for some of you, we have bonds also. So not everyone has the same portfolio. So I'm going to touch quickly first on the U.S. dividend income portfolio and tell you where we stand with that. And then we're going to go company by company a little bit and highlight a few. But what we've done over the past week is speak to management team upon management team upon management team and assess what's going on and where the dividends are safe, because I know most people on this call want or need that income and rely on it. So of the 37 stocks in the portfolio, right now 26, I have no, I'm not losing an iota of sleep over them paying the dividends. These are companies like the ones that we all know and suspect: Pfizer, IBM, Duke Energy, B&G Foods, AT&T, Verizon, AbbVie, the regular ones. Then there's other ones in there too, where they're not as commonplace names, but where we've spoken to them and we understand their business as well, and we've got no concern over them being able to pay the dividends. Those are Chevron, GM, Dow. I should have said those. Those names where we're super confident are CenturyLink, Umpqua Financial, WestRock, Hercules, Enterprise, Iron Mountain, Navient. I'm happy to get into more details on any of these. Then there's 5 in the portfolio where if this sustains much longer and is far more painful than we're anticipating it being right now, there could be risk. But at this point, I think if we come out of it on the earlier side rather than the later side, I think these guys are going to be fine. So those are Lamar, H&E, Tanger, Schlumberger, and Gannett. That's okay. Of the stocks where I think that they've already cut, they cut last week, or there's risk to them cutting the dividends, it's Ryman, Targa, Ford, Sabra, and Six Flags. Six Flags already cut, but whatever. But here's my point of this. This is manageable. So for example, what we'll do is we will sell Ford. We are not selling Ford last week, and we are not selling Ford today, but we will sell Ford, and we will replace it with CenturyLink, Navient, Iron Mountain, AbbVie. We'll replace it with one of the companies that we have huge confidence in. We're also working on new companies. One of the questions that we've been getting a lot is why not use this as an opportunity to really upgrade the quality of the portfolio? And that's obviously something we're doing. We've been researching companies, which I mentioned last week. We've been researching things like 3M, UPS, Cisco, but we need to maximize this and be really careful. So just to give you a quick example, and I'm getting a little ahead of myself right now, but on the call last week, we talked about some of the losing positions, some of the bigger losers. Those were things like Ryman, Targa, Sabra, and Six Flags. Those all will need to go. But just to give you an idea, since we spoke last week, since this time last week when we spoke, Ryman's up 133%, Sabra's up 60%, Targa's up 71%, and Six Flags is up 60%. So it's my job to minimize the losses on those and not just be like, we're getting out now, but to let those appreciate, get back to where they actually should be trading, and at that point, sell them off and replace them and keep the income the same. And I don't have any concern at this point about not being able to manage the income part of it, so that at the end of all of this, the income might be a teeny bit impacted, but it should be so negligible that unless I point out on your quarterly reviews, hey, your income was 59,000 and now it's 58,000, it should be negligible and it should have no impact on your life. If this gets better faster, there might not be any impact on that. So that's where that is. What some of the interesting things that I just wanted to highlight from calls this week are conversations or press releases that we've seen. So I just want to run through some of these, and then Greg's going to touch on some of the positions in the international and growth portfolios. But AbbVie, for example, which I think is really amazing, actually gave up their patent rights on the drug that in their pipeline that has the most likelihood of successfully being able to treat this COVID-19. I think that's amazing. And they're saying, okay, you know what? Fine, we don't need to make money. We just need to make the world a better place. Patent rights are off. Everybody work on what we've got going. Dow pivoted and decided to start making, was able to start making hand sanitizer. CenturyLink, which we own, is, I spoke to the management last Friday night. As it turns out, Zoom, which we're on right now, CenturyLink this is the company with 500,000 miles of fiber in the US. They are Zoom's largest supplier of capacity. So that company is going to be A-okay. They get punished because they have leverage. They have $1 billion of debt coming due in a month. The cash is already set aside. They're fine, but the stock gets punished a little bit. I actually added to that this morning when it was down a little bit. And so I think we'll come out well on that. It's trading with a 10% dividend yield, and there's just no risk on that dividend. Umpqua, this is really interesting. One of our small regional banks that's focused in Seattle and Oregon has been punished tremendously too and is down a lot. They're fine. Their dividend is incredibly safe. The management told me there's very, 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 very little risk of anything happening to the dividend. They cannot legally tell me it's 100% safe. But one interesting thing that they said on that call was that in the U.S. pipeline right now, there's $9 trillion of refinancing, of demand for refinancing. Meanwhile, the U.S. system is only able to handle about $2 trillion. So on the regional banks, where they are taking advantage, where people are trying to take advantage of lower interest rates and refinance, the regional banks are actually able to make more money than they would have otherwise on these refis because of the supply-demand imbalance. And that's really positive for a company like Umpqua. So we'll probably end up adding the Umpqua too as we start to reposition out of the losers and into the high conviction, super secure companies. Let's see, who else was on there? Yesterday morning, I listened to, I think, one of the most fascinating calls I've ever heard, or maybe most emotionally fascinating from an investment perspective. There was a joint call by Ford, GE, and 3M. And the three of them in 4 days have come together to team up to make face shields, and respirators. And they're using Ford's engineering, GE's expertise, 3M's processes, and they're coming together and they're going to just increase supply so that we can get through this. It was a really cool call. Couple of others. General Motors, for example, made a big announcement. Boy, time's going so fast. I think this was Monday. I was thinking it was yesterday. But they made a big announcement that they're drawing down cash from their revolver, so they have $30 billion of cash on their balance sheet. They're going to be fine. This is when, if they were going to do anything to the dividend like Ford did, they would have done it. They did not. Chevron specifically put out a press release, and the CFO said, our focus is on protecting the dividend, prioritizing capital that drives long-term value, and supporting the balance sheet. Chevron's fine. ONEOK, which is an MLP, midstream company that's in the portfolios where people don't want the K1s, we spoke to them today, super interesting, and they reiterated the same thing that we've heard from Magellan and Enterprise, which is when oil prices tanked in 15, 16, the break even to be productive in the US for many of the shale plays, oil had to be at $40. At this point, it's $30 because of technological improvements even over the last 4 years. So even though oil prices look terrible and the stocks have gotten slapped around, the reality is many producers are very close to break even, and we are still using a tremendous amount of fossil fuel to keep the lights on. So ONEOK said, and this is the same, by the way, at Magellan and Enterprise, they said, look, we started the year saying we were going to increase the dividend by 9 to 11%. That's obviously not going to happen. And they said, but, and again, we can't tell you the dividend's 100% safe, but we don't think this is as bad for us and for what our acreage is. We don't think this is as bad as 15, 16, and we had no problem maintaining the dividend in 2015, 16. So that's where I move that into the category of extremely highly, hugely confident, safe, and comfortable. Greg, do you mind touching on some of the companies in the growth portfolio and the international portfolio?
Yeah, I'll touch on the international portfolio first. The international portfolio tends to have less companies canceling their dividend overall, just because most companies outside the U.S. have a flexible dividend policy, so they're more likely to reduce the dividend by a small amount than to cancel it completely. We only have out of the portfolio, there's most of the companies where feel 100% confident that they will maintain the dividend. We have only a small handful of companies where there is a question mark. That would be the energy companies. Perhaps the miners could cut their dividend. And also the one I would point out is Las Vegas Sands, is a company that has 90% of their profits come from casinos in Asia. The shares are down 25%. It's yielding 7%. It's one where the casinos in Macau and Singapore have been greatly impacted, and it would be understandable if they did cut their dividend. They've given no indication either way. But if they did cut their dividend, we could easily replace it. It's yielding 7%. It's not hard to find quality companies right now that are yielding 7% in Europe and Asia. But we think Las Vegas Sands is pretty interesting right now that casinos in Macau have already reopened following the coronavirus shutdowns. Singapore, their large hotel entertainment resort has stayed open with restrictions. So business is down, but we can see how business is starting to recover already. There could be a good opportunity if they maintain their dividend. Elsewhere in the international portfolio, we've got a lot of companies where the share price is down significantly, and there's very little impact from the coronavirus on the businesses. I think the best example of this is GlaxoSmithKline, the European-based pharmaceutical company. Shares are down 25%, which brings the dividend yield up to 6%. The dividend is well covered by the earnings. They've got a very minimal negative impact from the coronavirus. If anything, Glaxo, they're a pharmaceutical company whose strength is in respiratory drugs, vaccines, and HIV treatment. So I think 3 areas that could be of value in the race to come up with treatments and vaccines for the coronavirus. So if anything, in the long term, they may benefit from this. But yet the shares are still down 25%, and they've got a 6% dividend yield that looks very safe for the well covered by earnings for the time being. Elsewhere in the growth portfolio, fortunately in the growth portfolio, we don't have to worry about dividend cuts, since the mandate is to find companies that are growing earnings as opposed to paying dividends. One example that we own, I think, a portfolio of high quality companies that are growing. I mean, there is some economic sensitivity, but one example, the largest holding in the portfolio is Home Depot. Home Depot is down 25% from the peak. It's definitely facing a slowdown in sales due to the coronavirus, but we think in the past, during the housing bubble, the bursting of the housing bubble and the financial crisis, Home Depot during that managed to stay free cash flow positive throughout. And we think the coronavirus for Home Depot is going to have much less impact than the housing bubble bursting. And they think when the coronavirus ends, they're going to be in an environment of low interest rates, low oil prices, and then people with stimulus checks looking to spend, and there should be some pent-up demand. So I think Home Depot, along with many other companies in the portfolio, should has the potential to emerge from the coronavirus actually in a stronger position going forward, and they're certainly trading at much cheaper prices than they had been in the past. So there should be some good opportunities.
Right. One of the things Greg and I have been talking about is that last time around, when this was so tough after 2008, 2009, everyone was saying, the term that came out of it was too big to fail. And what we've been talking about this time is it's straight up too many to fail. There are too many businesses. There's too many important restaurants and stores and salons and businesses like ours and businesses like all of yours. There are just too many to fail. And somehow I'm quite certain that the American people and the American government are going to come together and support this. So I just want to wrap up with two things, and then we actually had people email questions. So I'm going to answer the couple of email questions, and then and you're welcome to ping me with emails right now too, unless when I take it off of mute, you want to ask them. But one of the things that's really struck me in the past week and a half that's so different this time about 2008, 2009 and the conversations is that in 2008, 2009, when the market was actually down way worse than what we've seen so far, that was a long, protracted, drawn out time. And most people, unemployment hit 10%, but that means 90% of people were still working. And they were still going about their days as usual, coming home, getting gut punched by the market, calling their portfolio manager or advisor. And, it was us who were the bearer of bad news. And it was really, really difficult, nuanced, hard to explain, like black hole kind of bad news on, they collateralized loans and they packaged them and they said they were safe and they weren't safe, and like these spiral effects are happening. This is really, really different this time. And the client conversations have been really different too. I think this is, well, fast and horrible and dark and scary. This is understandable in a way. And I should look at this real quick. This call that Greg and I were on with AEI was interesting. So after that, Scott Gottlieb spoke, they had a policy expert, and he said, this is the big one. This is in the global public health sector. This is the big one, and this is what everybody, talks about as the big one. And he said the fact that our government wasn't ready should not be an indictment of the government. That it's hit all governments out of the blue, and I think it's hit all of us out of the blue too. And so there's just this sense of us all being in it together. I also think, as I compare this to 08, 09. This to me has a finite end coming. And we've been so mobilized as a society. When I talk about Ford and GE and 3M coming together to make respirators, and Dow pivoting and making hand sanitizers. And I just read an article this morning about a company in Brooklyn that used to make signs, or up until, used to, as in up until a week ago, was making signage for Nike stores. They pivoted and now they're making face shields. We are coming together as a society, and I really do think that we're going to come out of this in a very different way. Which actually, one last thing, because that does segue straight into one of the questions I got. But one of the things that Greg and I were joking about is, would you rather have death by 1,000 cuts like 08, 09, or would you rather just get this over with, and have something big and scary? I don't think we'd rather have either, but it's just an interesting thing how different this is. And I think maybe we are a little, I don't know, exhausted and coming up with unfunny funnyisms. But so I think I'd rather deal with this from an investment perspective than what we dealt with last time. This, I feel like we know how to get through, and we're going to get through pretty well. Okay, so one of the questions was, will this recovery be V-shaped to a new normal that's lower than before? I don't know about the V-shape. I know I've said this a few times. I think when we get past maybe the next 2 weeks and we have real data and we see what the end is looking for, I think at that point we'll have a ferociously quick leg up on the upside. I don't know what the new normal is going to be. I know if I look at a long-term chart of the market, it's not, the new normal will not be lower than before in the long run, right? You can look at a 100-year history of the market with everything that's gone on. It always trades higher. It's just how long does it take for us to get there? but I'm not so sure it's going to be a V-shaped recovery. And even though we've had a couple days yesterday and today of remarkably wonderful market returns, there's going to be uncomfortable things that come up in the next couple weeks or months, and that could give us a few gut punches in the meantime. And maybe that's when I get to buy 3M.
And I would just to chime in, I always remind Jenny of this. The number of cases, confirmed cases of coronavirus, is going to lag the actual transmission. So even though we're doing a lot to try to contain the coronavirus over the next week or two, there still can be some really ugly data. So even though we have this great policy response, the data may get a lot worse before it gets better. So we can't be sure that this is the bottom.
Right. So one of the questions that we've gotten a couple times in the last 24 hours, and I think this came out of the proposed package that Nancy Pelosi was suggesting, was will companies cut back on stock buybacks to maintain stock price and cut stock dividends so that they can use more money to save for economic downturns? On stock buybacks, I think there is pressure to cut back on that, especially from any company that gets any government funding. I think the dividends is probably not something that companies will cut back on, because all of the companies that we own, they know that they're not high growth companies, and they know that a huge part, if not almost all, of total shareholder return is that ability to return cash through cash to shareholders, from being a bit of a cash cow but not a high growth company. So that's philosophically how they operate. One client just asked what the yield is on the portfolio. On the U.S. dividend income portfolio, the yield is about 8.79 right now, so that's pretty strong. Hang on, I just got another one. I'm gonna look at this real quick. I just got another one. What are other holdings that have been hard hit that we might add to? So that list is robust because everything has been hard hit. But some of the companies that I feel most compelled to add to are WestRock, Navient, Enterprise, Magellan, OneOak, Compass Diversified, Covanta, Iron Mountain, Dow. I forgot Dow. I should have said Dow. Umpqua, and like I said, CenturyLink. So those are some that have been really disproportionately hit hard. Okay, let me just check for any more email questions, and then I think I'll open it up. Greg, you got anything?
No, let's hear some questions.
Okay. All right, I'm going to take you all off of unmute for a minute, okay? Okay, everybody's unmuted, so don't say anything bad in the background. Does anyone have any questions? Uh-oh. I think someone's breaking
Jenny?
up. Yes.
Jenny, you gave us the companies that cut their dividends. Are there, how many companies have cut them back but not eliminated it?
Oh, sure. So only two have cut them, and actually both suspended them. So the only two that went to zero for right now are Ryman and Ford. And they both actually sorry, go ahead.
I've got
and they used very specific language that they were going to suspend them until they have better visibility. I think it's going to take Ryman a little while to get there. And Ford, that just depends. So I don't really fault them on that. I just want to give a quick example on that Ryman, for example. When we spoke to Ryman's management team 2.5 weeks ago, they said 75% of our March bookings are being canceled, 25% of April. A week later, March and April were canceled. Last night, they put out a press release saying, we're going to work with the government and close our hotels for the next several months completely. So that's how rapidly things have changed for them. And I think this is where I go to that comment too, where this is the big one. 3 months ago, a month and a half ago, Ryman had all 5 hotel convention centers fully booked. And by the way, Ryman actually has a huge part of their revenues booked out 5 to 7 years in advance, as these major companies need to plan their conventions that far in advance. So those are the only 2 that cut all the way. Sabra, I spoke to the CEO. I don't know that they're going to cut, but I'm pretty sure they are. And if they do, he's going to do as much as he can, such that it doesn't need to be more than 1. And then the goal is, as soon as they come out of this, to get it straight back up. So that's on my list of cutting or will cut. Six Flags, we all know, already cut a few weeks ago, so they're on that list. And then Targa cut the night we spoke. So they cut last Wednesday. And just in a quick aside there, I had spoken to the CFO, I believe that morning of the call last week, and they put out a big press release. They said, look, we're fine, we're solvent, we're okay. You know, business is not that bad, but we are going to conserve cash. We're going to cut the dividend. Again, not to zero, but they cut it significantly. And obviously the goal is to get it back up. At 12:34 a.m., that poor CFO was emailing me saying, did you see the press release? Are you okay? I'm 100% here for you if you need to talk more. So those are the ones who have cut. You have more questions on that, Bob?
Is there an Umpqua Holdings?
Yes, Umpqua is terrific. That's that regional bank that I had mentioned before, and
Okay,
and they're the
but
ones who are doing the
have
mortgage refinancing.
Are they do? But they cut their dividends.
No, not at all. They're the ones who said it's very, 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 very safe. They'll probably come out of this in extremely good shape.
Okay, but it doesn't show up on my reports as a dividend paying.
Don't worry about that. That we'll talk about offline. Got a big dividend.
Okay.
I'll tell you, hold on. I'll tell you what Umpqua is right now. Umpqua right now has a 7.8% dividend yield, and that's very, very, very safe. Okay, anyone else have any questions?
Yeah, hi, Jenny. Great.
Hi.
Yeah, the stimulus package is $2 trillion. The deficit before this crisis was $1 trillion. Now it's probably going to grow to $1.5 trillion to $2 trillion. So it's $4 trillion this year in deficit. What does that mean? What does that mean longer term for interest rates and inflation?
Sure. Greg, do you want to take that?
Yeah,
Greg's our macroeconomist.
I can't wait for the day where the coronavirus dies down so we can actually worry about things like that, about the growing budget deficit and the amount of government debt to GDP. The U.S. has an extraordinary advantage over all other countries right now in that it's the fiat currency, it's the bond market of choice, and in times of crisis, money flows into U.S. treasuries, and the U.S. is certainly taking advantage of that. So they can, issue a $2 trillion stimulus package, and the bond market doesn't even blink. And the Fed could have unlimited buying of treasuries, and the currency barely moves. That may not last forever. There may be a time when things settle down, and when government debt to GDP is at elevated levels, that people are more concerned and causes bond yields to start to increase. But that certainly is not today. That could cause the dollar to go down, which would make goods more expensive, but with oil trading well below $30, that's not going to be a concern today. But there's no free lunch, and a $2 trillion spending is going to have consequences, but those are down the road.
Right. One of the things we were talking about, Greg and I did a call with one of our friends who's a portfolio manager at Neuberger Berman this morning, and we were talking about this. And if this were 3 weeks ago, we'd be, or no, that's not fair. If this were 6 weeks ago, we would be disgusted, devastated, up in arms about this in a different way. And I think where we all were this morning was like, this just has to get us through. Let's worry about that. Let's try and re-elect some politicians who can take us out of this deficit situation in the future. I think it's going to be meaningful. I hope it enters the real public conversation. But for today, we just need to get through this. All right, who else has questions?
Jenny.
Yeah.
It's George. How are you?
Good, how are you?
Good. The issue I have, one of the questions I have, being that the actual principal balance of folks that people's accounts has dropped rather, I would say, significantly in some cases. I know where we have an income portfolio, at least I do, and it's generate X amount of dollars based on the original cost basis of the shares purchased. I wish we were purchasing something today and we could get a higher return. However, now when we're looking for income and possibly principal to remove from our accounts, how are we going to adjust our portfolios to be able to capture some of that upsurge, so to speak.
Well, okay, yeah, sure, go ahead.
Something like Home Depot, which is now trading at, I
Right.
think 180 something, and IBM or even Microsoft, which I just look at, but it's not in the portfolio. I think it might be, but I'm not sure.
It's not in the dividend income it's not in the strategy.
Yeah.
Okay, so one of the ways that we're gonna capture upside is by keeping our wits about us and not selling at these low points and knowing that when the market recovers, we too will recover. And that's where I let off the call saying, thank goodness, there seems to be appreciation for these, formerly known as, and hopefully in the future too, the flight to safety companies, where they have significant free cash flow and a relative degree of economic insensitivity compared to other companies. And I think that money will flow back into those. So by staying invested alone, we will see, as the market returns, we will participate in that. Where there is cash, right, because we had that pattern, again, if you came in later to the strategy, you didn't own this, but anyone who was with me last January and most of last year owned Pattern Energy. Pattern Energy was bought by a Canadian pension fund. That was bought for cash. So last week we had cash from that position come in. We will take advantage of the future upside and increase the income by reinvesting the proceeds from Pattern Energy into new companies. We'll reinvest, we'll sell Ford. Ford's up 15% today. So we're gonna let Ford ride a little bit more. But then when we sell Ford, we'll put it into maybe something like Dow or Navient, where there's significant safe income, also significant upside on top of that.
Every one of their holdings, I'll let you look at it.
So that's the way that we'll take advantage of that. But you just made me think of one thing. I just want to, for anyone who's online, and if you have the email that I sent out earlier, I just want to stick up a slide. Hold on, let me just share. I just want to remind you all that, hold on, how do I share? I'm not so good at this. Okay, so there's a slide that I put up in the email that I sent you. It shows that the share price, I just used IBM as an example, but what you see is that the share price can go up, down, all over the place. And what you see is that the dividends, and this is true for many, 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 many companies in the portfolio. Some of the dividends are flat, but what you see is regardless of the share price, the dividend that that company pays out increases a little bit each year. And so that's what, as we replace, we're going to look for companies like this, where the share price might be down, which makes the yield more, and we have a lot of conviction that those dividends are going to stay that stable throughout. Okay, any other questions? Craig, you raising your hand? Okay. Anyone else got anything? Yeah.
And Jenny, I got some questions. Jenny, I got some questions to Bob here, and can you give me a call when you get a chance? No rush. I have some
Absolutely.
questions.
You got it. Okay, and you all know I'm happy to take calls offline, and just don't hesitate to call me, please. Anyone else got questions?
I have another question, Jenny. I'm sorry, I missed what did Scott Gottlieb say today? I missed.
Oh, sure. And you know what? I forgot to hit record for the first 3 minutes of the call. He was super, he was super interesting. But if you don't mind, George, can we talk about that offline so I don't reiterate it all now? And what I'll also try to do is I'll try and find a transcript of it or a write-up, because they usually do that, and then I'll send it around to everyone, because he was so fascinating. And I don't know about you, Greg, like to me that was one of the most fascinating conversations that I've heard him go through, and maybe it's because he's starting to turn the corner on seeing the end. But amongst the other things he said is, Cuomo's out there saying right now 2 to 3 weeks, and Scott Gottlieb, who's been very pragmatic, very realistic, and to most people very negative, said, it might just be 2 weeks before we see the end of it in New York. We're already a week and change into this. So there was
Well, not the end. That's the peak.
I'm sorry.
The peak in
I'm
cases
sorry.
in 2 weeks.
Major clarification.
Yeah.
Thank you. You got it. Okay, who else has questions? Okay, please don't be shy to call me, email me, whatever works. I'm lousy at text, so don't text me. Okay?
Thank you.
Thank you so much. And let me know if you want to do it again next week. I'm happy to do this as much and as often as we need. And
Thanks,
hopefully
Jenny.
the title will change
Thank you.
from like Misery Loves Company to like, I don't know, something cheerier.
Jenny, will you be doing this next week?
If everyone wants it, I will do it next week too. Whatever you all, okay, I'm getting thumbs up.
Let's
from
do
Karen.
it.
Okay, we'll do it.
Can't see us.
Yeah.
3.0.
Very good, thank you.
How did you
Oh,
see my thumb?
Okay.
Thanks, Jerry.
Thank you. Bye-bye.
Bye-bye.
Thank you.
Thank you.
Bye.
Bye.
Thank you.
Well done.
Thank you.
I turned off the audio so they don't hear me.